Welcome back. We just got finished talking about the 4 different types of sales transactions that merchandisers can encounter when selling their goods. In the second half of Chapter 7, we'll talk about special topics in merchandising. These will include sales returns and allowances, trade discounts, sales discounts. We'll then show you how the presentation of the sales accounts on the income statement looks, and then we'll introduce the topic of subsidiary ledgers. Sometimes customers aren't happy with the product that the business sells. When this happens, a sales return or sales allowance is generally made. The sales returns and allowances account is a contra revenue account that keeps track of all customer returns. If the company originally sold the merchandise for cash, then a cash refund is given along with the tax paid. If the original sale was on account, then a credit memo is given. We will look at both of these transactions in a little bit more detail. When a customer returns a product, the business makes an opposite entry of that of the sale. But instead of debiting the sales account, we debit a brand new account called Sales Returns and Allowances. The Sales Returns and Allowances account is a contra revenue account that keeps track of all customer returns. It's a temporary account that is eventually closed at the end of the accounting period. It will show up on the income statement as a subtraction from the sales account. We'll take a look at that more in detail later. If a customer previously purchased our merchandise for cash, then a cash refund needs to be given back to him when the goods are received. To record a cash refund, we debit the brand new contra account called Sales Returns and Allowances. We also debit sales tax payable to give him or her the tax back with a credit to cash upon payment of the cash refund. A credit memo is issued to a customer in the case that something needs to be returned. This credit memo details out of exactly what was being returned. In this case, a weight set that was originally sold for $200 and for which $16 in tax was paid is returned. The item was previously issued on account. Assuming the item has not yet been paid for, a credit memo is issued by the seller to acknowledge the return, and the following journal entry would be made. Based on the credit memo, we would debit sales returns and allowances for the $200, the cost of the merchandise that was returned. We would debit sales tax payable for the $16 in order to return the tax to the customer, and we would credit the accounts receivable or the amount due from them for the sum of the total. Sometimes companies offer trade discounts, which are volume-based. This means that the customer can pay less than retail price. Sometimes businesses might offer goods to different customers at different trade discounts based on the volume purchased. Trade discounts are not recorded in the actual accounts. Rather, the sale is recorded net of the trade discount. In this example, let's assume that the list price of something that an ordinary customer would walk in and pay is $1,000. If a company does a lot of business, the retailer or wholesaler might offer a 30% discount across the board. This means that a $1,000 list price would be reduced by 30% or $300, bringing the net price of the goods sold to $700. That sale would be recorded net of the discount at $700. If a larger customer comes in or a customer increases the amount of their purchases, they might be offered a bi-level discount. In this example, we'll assume that the bi-level discount is 30% and then another 15%. Many students make the mistake of taking 45% off the list price. However, this would be incorrect. The correct accounting would be to start with the list price, take off the first 30% discount, which would mean a minus $300, giving us a first level price of $700, and we would apply the next discount of 15% in this case to the $700, giving a second discount of $105. This makes the final net price $595, or $1,000 minus $300 minus $105. These trade discounts would not be recorded in a special account. Rather, the net sale by the retailer or wholesaler would be recorded at the net price of $595. Sometimes companies will entice customers to pay early by providing incentives to do so. These are called sales discounts, and they are often presented in a fractional form. For example, a 210 net 30 discount would mean that a 2% discount is offered if the company pays within 10 days. Otherwise, the whole thing's due in 30 days. Prompt payment discounts are recorded in a special account called sales discounts. If the customer takes advantage of the discounts, then we would record this. Let's take a look at the journal entry. Cash discounts are taken when the payment is received. In this case, the original sale was made for $2,000 with prompt payment discounts offered to the customer. The credit terms of this sale were 110 net 30, which means if the customer paid within 10 days, he was entitled to take a 1% discount. If he chose not to take advantage of the discount, then the whole amount due would be paid in 30 days from the date of invoice. The journal entry to record the initial sale and the subsequent cash receipt within the 10-day discount period is shown. Notice that a 1% discount off of the original sale of $2,000 resulted in a prompt pay discount of $20. This $20 discount is recorded in a special account called sales discounts. Sales discounts will be used to offset the sales value on the income statement. We'll see this later in the video. Since we changed our focus from a service-oriented firm to a merchandiser, that means that some of our financial statements are going to take on a different appearance. You'll notice that the income statement that we will be looking at much later is called a multi-step income statement. If you want a preview of what it looks like, you can go to the Chapter 13 section of my traditional website and see what you're in for. This means that we need to now start learning different components of a massive income statement that's coming later. In this chapter, we will learn how to present the sales-related accounts. Let me show you what I'm talking about. The first chunk of the income statement for a merchandiser is called revenue from sales. In this example, the sales generated by the merchandiser totaled $100,000. However, there were two contra accounts that pulled the sales number down. There were returns and allowances totaling $2,000, and there were sales discounts offered for those customers which paid early in the amount of $2,500. This means that there were $4,500 of offsetting amounts, which took the sales down from $100,000 in gross sales to net sales of $95,500. This is how the first chunk of your income statement will look when we later create a multi-step income statement. It's important that you learn these chunks by chapter so that when we do hit the multi-step income statement, it won't seem so overwhelming. The last final section of the chapter is on a brand new concept called the subsidiary ledger. Subsidiary ledger is a fancy word for part. Accounts receivable can be a very large asset for a merchandiser, and it's important to have a mechanism to track the individual customer balances at all times. To do this, we introduce the concept of an accounts receivable subsidiary ledger. The accounts receivable balance in the general ledger will now be called a controlling account. It will still work the same as it has always worked. However, it will now be supported by individual customer balances that will be tracked in the subsidiary ledger. The subsidiary ledger tracks the individual amount owed by each credit customer. This subsidiary ledger could be compared to a notebook that had one page for each customer showing all the activity that happened over the accounting period. At all times, the sum of that notebook, the sum of all of the pages for all of the customers, must always balance back to the controlling account called accounts receivable. Another way of looking at it is that the sum of the parts always has to equal the whole thing. In other words, from here on out, every time we touch accounts receivable, we will have to do an extra posting to update the accounts receivable subsidiary ledger. From this day forward, you can't touch accounts receivable unless you designate a specific customer and go update the subsidiary card as well. The way that we will prove that the sum of the parts equals the whole thing is through the schedule of accounts receivable. This means that at whatever cutoff date the company chooses, we will list each individual balance from the accounts receivable subsidiary ledger, total it up, and ensure that it agrees back to the accounts receivable balance in the general ledger. In other words, the sum of the individual customer balances must equal the total in the general ledger. This is called the schedule of accounts receivable. As previously mentioned, an extra posting is necessary now that we are using the accounts receivable subsidiary ledger. Take a close look at your textbook that understands step by step how the postings are made. Notice the small check mark on the accounts receivable line item that shows that the amount has been properly posted to the customer's card. This final slide illustrates the relationship between the accounts receivable controlling balance in the general ledger, the accounts receivable subsidiary ledger, and the schedule of accounts receivable. Take a moment to review how they are all interconnected. Of course, the best practice for this is to sit down and try a couple of problems. Topics. We learned about returns. We learned about trade discounts. We learned about quick pay or prompt discounts. And we learned about the accounts receivable subsidiary ledger. This chapter is our introduction to merchandising entities, so spend enough time to master the chapter. This is Professor Johnson signing out. This is Professor Johnson signing out. This is Professor Johnson signing out.